All right, welcome everyone. Today we're here to focus on how to proactively maximize value of your business, not just for a sale, but to create options, security, well-being for yourself, your families, and your teams. We believe in holistic planning, integrating business growth, personal wealth, and general well-being, all of which really do need to be maximized. Throughout the session, we'll talk kind of key drivers of value, common pitfalls, and some strategies that really do make a difference, not only when it comes to exit, but in building a thriving business and fulfilling life. About H&S. So at H&S, we do more than just provide accounting and tax services. We serve as proactive advisors working side by side with business owners to help them grow, scale, and succeed. We have over 90 employees, over 11 locations throughout central and western Michigan, and we're really built to support owners at every stage, early growth through successful exit and beyond. With our advisory model, we don't just react to problems, we try to anticipate opportunities and challenges and help our clients make informed decisions before issues arise. Our core services are tax, accounting, payroll, assurance, wealth management, and our goal is to make sure that they are fully integrated so your planning is coordinated and purposeful. Your presenters today, I'm Brett Fillish. I'm a shareholder at H&S Companies. My focus is primarily business tax and advisory with a heavy emphasis on mergers and acquisitions, succession planning, and trying to be generally supportive in business advisory. Nelson?
Yeah, my name is Nelson Schrader. I'm a certified exit planning advisor here with H&S Companies. I've been working with H&S since 2019, and my primary goal is helping business owners take a more holistic approach to make the transition from pre-sale preparedness to a more successful post-business life.
All right, here's our roadmap for today. We'll cover kind of three key gaps for business owners to evaluate kind of a current financial check-in, where to really build value, de-risking the business, business and personal tax strategy, and then post-exit. I think first, though, we'll start with market conditions. So Nelson, what can you really tell us about what you're seeing in the market today?
Sure. So first things first, I want to start with a bird's eye view of the current landscape regarding exit planning. So over the next decade, we're looking at the largest transfer of wealth in history. So over 77% of baby boomer business owners are looking to sell within the next 10 years. That's over $1 trillion being transferred in small business value to a new generation over the next decade. Now, on the surface, that sounds like a great opportunity, but when you look closer, you start to see a massive supply and demand problem. When you have a massive influx of businesses hitting the market at the same time, it starts becoming a buyer's market. Buyers, whether they're private equity, competitors, or internal management, can afford to be incredibly picky. They aren't looking for just good businesses, they're looking for best-in-class assets. Add in the complexity around interest rates, tariffs, AI, and it's no wonder that 8 out of 10 exits today end up failing. So that's 80% of sellers going to market today don't end up reaching their goals on their sale. So our goal today is to give you the blueprint to be one of those 2 out of 10 businesses that succeeds on their own terms. Brett, what are you seeing on the market?
Right now, I think there's a significant amount of kind of dry powder capital that's ready and waiting to be deployed for the right business asset. I think if quality businesses do come to the market, this environment could quickly shift from kind of a buyer's market back to a seller's market. So owners who are well prepared and positioned to stand apart kind of benefit from this type of dynamic. With so much capital ready to be deployed, it's not just a market timing that matters, it's how well your business is prepared for the unexpected as well.
Great. And a lot of business owners ask me, so why do I have to focus on this right now? I hear it all the time. Nelson, I love what I do. I have another 15 years in me before retirement. And that's a fantastic goal, but I have to share a hard truth. 50% of all business exits are involuntary. Life happens. And, in particular, we're worrying about what we call the 5 Ds. Those are death, disability, divorce, distress, and disagreement with your business partners. You might not be planning to sell, but if one of these events hits your family or your partners tomorrow, a sale is going to happen whether you like it or not. If you're forced into a sale by a health crisis or a partner dispute and your business isn't buyer ready, you're at the mercy of the buyer. You lose all your leverage. You can't wait for a better offer. You can't spend 6 months cleaning up your books. You're having a fire sale. So that's why we really feel like it's necessary to prepare for a sale ready business today, even if your timeline is still 10 plus years down the road. So now onto the number side of things. When we're looking at maximizing value in the business, we're trying to identify what we call the 3 gaps. First is the wealth gap. This is the difference between what you have today and what you actually need for your future. If 80% of your net worth is tied up in your business is your retirement plan. We have to know what number we need to actually harvest from that sale to achieve the lifestyle you want before we head to the table to make that sale. Second is the profit gap. This is the difference between what your current earnings are and what a best-in-class competitor is achieving. If you're at $1 million in profit per year, but your peers are consistently at 1.5, we need to know why. This is a lot of times an operational efficiency problem. And the third is the value gap. This is the multiple. If your industry average businesses sell at a 4x multiple, but top tier companies are getting a 7x, that's what we call the value gap. On 2 million per year, that 3x difference, 6 million. Close that gap hard making more sales. You close it by reducing risk in your company, which is a lot of what we're going to be talking about today. So now for the value gaps, really those two sides of the equations, the earnings and the multiple. Brett, from your perspective at H&S, how should an owner be evaluating their earnings to make sure they're actually buyer ready?
Great question. To be buyer ready, I think owners should really make sure their earnings are clean, consistent, and can be sustained without them at the center of the business. Buyers really want to see that financials are creditable and easy to understand, but even strong earnings are just a starting point. Now let's walk through what owners actually receive on exit. This is a net exit waterfall. This is kind of a reality check for every business owner considering a sale. Enterprise value, or the headline sale price, is usually what you see and pay attention to in a deal, but it's really just a starting point. Before you reach kind of your net proceeds, there are several deductions that come into place. First, you subtract any debt, transaction costs, and any rollover equity. Almost all deals are cash-free, debt-free. So the first amount of proceeds are going to be used to reduce that. And rollover equity is something that you ultimately, you defer currently and you pick up on the backside, but it reduces your net take home. And then next you account for taxes, federal, state, net investment income tax, and these can really have a significant bite out of your proceeds. And the structure of your deal will really determine how much you owe. And then that bottom number, the net to owner, that's the number that actually funds your retirement, maybe your family's future, your philanthropic goals, or your next investment. So as you plan your exit, it's good to focus. It's not good. Don't just focus on that headline price. Really start to model out what that net exit waterfall looks like early. Understand what that means and look to find ways to kind of maximize ultimately what you keep. And then When buyers evaluate businesses, the first step is really to normalize EBITDA. That's your earnings before interest, taxes, depreciation, and amortization. This is really, generally the starting point for any sort of business valuation. Buyers want to see that earnings are consistent, sustainable, free from one-time or discretionary items. Pro forma adjustments, pluses or minuses to EBITDA, really help tell your story. This is how you show how your business performs under normal conditions and highlight your follow through and vision for growth. For example, if you've recently improved your job costing and increased your margins, these positive changes can be reflected in your pro forma adjustments. This really demonstrates to buyers that your business is not only more profitable, but better managed and positioned for future growth. By proactively working through and identifying these adjustments, you can craft a narrative that's creditable and compelling. Selling your business is really a sales job. And this not only defends your value, but also shows buyers you're prepared and thoughtful and focused on the future. The other side of kind of financial house cleaning is the quality of earnings. So there's a sell side quality of earnings that you can do to kind of take control of your financial story before buyers do. You would essentially conduct your own audit, normalize your own EBITDA numbers. You kind of build credibility and transparency in the buyer's eyes and kind of show them exactly what they're getting to reduce surprises. For sellers, this can be a very valuable process because you really learn about your business's strengths and weaknesses, and you can highlight action items that you can address before going to market. If you have time to implement changes, correct issues, and strengthen your position, you can minimize the amount of scrambling that happens during the buyer due diligence process. It's really a de-risking exercise. You proactively identify and resolve and remove barriers that could delay a deal, because everyone says time does kill deals. This speeds up the process, gives buyers confidence. So maybe Nelson, what can we focus on now that kind of drives value?
Yeah, so now that we've addressed kind of the earnings side of things, I want to look more at the math of the multiple. So most owners are always obsessed with growing that top line, and don't get me wrong, revenue is great, it's very important, but the multiple is really the lever that can move that valuation most significantly. So I want to give an example first of imagine your business generates $1 million in earnings. At a 4x multiple, you're worth $4 million. If you work incredibly hard and grow that profit to 1.2 million, at that same multiple, you're now worth 4.8 million. You've added 800,000 in value. That's pretty good work. But what if instead of pushing more sales, you spent that year de-risking the business? You documented your processes, built a management team, and diversified your customer base. Now a buyer says, that's a low risk, high quality asset, and they offer you a 6x multiple. That same $1 million in profit is now worth $6 million. You added $2 million in value without finding a single new customer. That's what we refer to as the multiplier prize, which is really our goal, trying to move you from an average asset to a best in class so you get paid for the quality of your earnings and not just the quantity. So what actually moves that multiple? Really, it comes down to what we call the 4 intangible capitals. The first is human capital. This is your team around you. Could you get up and go to Hawaii for 3 months without checking your email? If the answer is no, you have a human capital problem. The second is structural. These are your systems. Is your secret sauce documented that makes your business successful? If the process that makes your business successful is only in your head or in the head of the owner, it's not an asset, it's just a liability. Third is social capital. This is your brand and culture, how the company interacts with the world. And lastly is customer capital. And once again, this is all about risk. If all of your revenue comes from one client, you aren't just a business, you're an extension of that client. So I actually saw this firsthand with a manufacturing owner we worked with. He was proud of his numbers, revenue was up, margins were great. But when we took a step back and looked at his customer capital, one single retail client accounted for 40% of his revenue. He didn't see that as a risk. He saw it as a strong strategic partnership. But when we brought a buyer to the table, that buyer saw it as a massive liability. They told him if that client walks, your company could go under. So that buyer ended up demanding a lower multiple, and he lost nearly $2 million in the potential valuation for that deal. His business was successful because he had the revenue, but he wasn't attractive to a buyer because he lacked the independence a buyer demands. So a lot of this comes down to one of the largest tasks of de-risking a business is reducing its dependence on the owner. I kind of talked about it in the last slide, but I call this the 30-day or the 3-month vacation test. So if you as the owner were to go take a 30-day vacation to some remote destination, completely off the grid, no phone, no email, would your business be worth more, less, or to be completely bankrupt by the time you returned? I hate to say it, but if your answer is less valuable, you don't own a business, you own a high stress full-time job. A buyer isn't looking just to purchase your revenue or your profit. They're purchasing the systems that generate that profit in your absence. If the business can't run without you, it's not a transferable asset. The business sees it as a liability that will struggle to survive the moment the owner walks out the door.
Once you've reduced kind of your operational risks and made your business less dependent on one person, you increased your attractiveness to buyers. Um, but maximizing what you keep from a sale isn't just about operations. It's also about smart tax planning and choosing the right entity structure. Let's shift gears and look at how proactive tax planning can have a major impact on your net proceeds at exit. Optimizing your entity structure is one of the most strategic decisions you can make, both for your day-to-day operations and for a future sale. The right type of entity can really facilitate a smoother sale process for a buyer, making it more attractive, help you incentivize key employees, maybe through additional equity, profit sharing. It's a one way to really address the human capital intangible. The right entity structure can provide optimal liquidity and leverage before a sale, maybe allowing you to pull more in wages, distributions, benefits, can really be positive cash flow to owners in the interim period. And then you want to make sure it's really aligned with your long-term wealth and legacy goals, ensuring your business supports your personal and family objectives. When it comes to taxpayer types, each has its unique advantage. With C Corps, there's a qualified small business stock, which can potentially reduce all or most of your tax liability on exit. It's a great planning tool when we have enough time to structure into it, but there are pros and cons to each structure. S Corps and partnerships offer more flexibility leading up to sale, but they all come with their own rules and limitations. Choosing the right structure isn't just about minimizing taxes, it's about supporting growth, rewarding your team, and kind of maximizing what you keep at exit. By reviewing your structure now, you can position the business for operational success, attract and retain talent, and ensure you're ready for a future sale on your own terms. Tax structuring of a transaction is also critical. Asset sales also often result in higher taxes for sellers, while buyers may prefer them for tax reasons. Stock sales can be more tax efficient for owners, but may require additional negotiations to get buyers comfortable. Being prepared for common restructuring steps and how to negotiate a purchase price allocation are also key and have a direct impact on your tax bill and your net take home. Negotiating deal structure is really just all about balancing price, risk, taxes. The right structure can maximize your net proceeds and kind of minimize surprises. After the sale, several factors can really also affect your outcome. Rollover equity means you keep a stake in the business post sale, sharing in the future upside. Seller financing can help uh, bridge valuation gaps, but comes with risk and potential delayed liquidity. Earnouts are tied to are part of your proceeds, but tied to future performance. So it's good to understand terms and likelihood of outcome. Post-sale employment is generally required as well, especially in strategic or management buyouts. Understanding what that means is very important. Each of these elements should be considered proactively as you're prepared to negotiate from a position of strength and look to maximize what you keep. But as we start talking about exit planning, it's important to remember that it isn't just a business transaction. It's a wealth and a family event. By starting to review who owns the business today within the family and who you want to own it at exit, you want to think about family involvement, who is active in the business now, who isn't, and what that means both for you, both for liquidity and for legacy. You want to treat this exit as a family balance sheet event, not just a sale. The decisions you make now will impact your family's wealth potentially for generations. One of the most powerful tools is kind of the pre LOI or pre letter of intent gifting window. By transferring ownership to heirs or to trusts before a letter of intent is signed, you can generally capture lower valuations and apply marketability discounts, allowing you to shift future appreciation outside of potentially a taxable estate, or to get it in the hands of kids and other family members at lower values. The key is really to plan early and coordinate your business and family goals so your exit supports both the financial legacy for yourself and for your loved ones. When planning for an exit, it's also important to consider not just the sale itself, but how you can use maybe charitable other gifting strategies to optimize your outcome. There's charitable tax offsets, allowing you to lean into your philanthropic side, and also reduce your tax liability in the year of sale. On the gifting side, there's many advanced strategies that let you move kind of future appreciation out of your estate. By acting before a sale, you can really shift significant value in the process. It's not just about the tools, though. It's about balancing trade-offs. You need to consider how much control you want in that process, how much you want to retain, your need for personal liquidity, and just your general long-term family objectives. Coordinating this type of planning with your deal structure and exit timing is essential. The best results come from integrating these strategies early, so you're not forced to make rush decisions under pressure. I think ultimately, thoughtful planning in this area can help you achieve philanthropic goals, provide for your family, and really maximize what you keep after sale. And then when it comes to exiting your business, there's really no single best path. Each option comes with its own set of pros and cons. Whether you're considering a strategic sale, an ESOP, employee-owned stock option plan, private equity, or management buyout, the right choice depends on your unique goals and circumstances. What's really most important is to weigh the key considerations. How much liquidity do you want up front? And how much control are you willing to give up? What is your timeline? And how much risk are you comfortable with? How do you want your legacy and your key employees to be treated after you transition? And finally, what matters most, potentially your net take home, and how tax efficient each option is, and what you actually get to keep. By focusing on these questions, you can really make a decision that aligns with your values, your financial goals, and your vision for the future. What other considerations are there, Nelson?
Yeah, so kind of a recap, preparing for a sale is often just misunderstood as just the business planning side of things. But in the exit planning world, we like to look at it what we call through the lens of what we call the three-legged stool. For a transition to be successful, we have to balance these three distinct areas: the business, your personal financial plan, and your personal purpose. The first is a lot of what we talked about so far today, the business, growing revenue and earnings, documenting processes, reducing risk, tax planning, entity structure, all of that. There's the personal financial leg of knowing exactly how much you need net after taxes to support your lifestyle for the next 30 plus years. Selling the business for $3 million might sound great until you realize you need $6 million to actually retire. We need to know also how to manage those funds to become a paycheck for you in retirement. That's where the wealth gap really comes into play. And then lastly is the personal purpose leg. For most business owners, your business is your life. It's where you get your social interaction, your sense of worth, your daily rhythm. If you don't have that third act planned out, which is a reason to get out of bed the day after you sell, there's a good chance you end up regretting the sale when it's all said and done. In order to facilitate a successful exit, we have to look at this with a holistic view to make sure we're growing all three legs simultaneously.
If you're thinking about the next chapter, whether it's growth, succession, future sale, now is really the time to start planning. There are many great advisors out there, but we'd love to partner with you at H&S Companies, provide some proactive and integrated advisory support. We'll help you anticipate opportunities, address challenges before they become problems, and help build a roadmap that aligns your business, personal, and family goals. Please reach out for any sort of confidential conversation or baseline assessment, and we'll work together to maximize your value and create lasting success. I think that concludes our webinar. So we wanted to thank you for attending, and please reach out if you have any questions.
Thank you.
Thanks.